A single decision, 12 words in a Federal Reserve statement, and the largest wealth transfer in human history began. Ladies and gentlemen, we need to talk about what happened at exactly 2:15 p.m. Eastern Standard Time this week. The Federal Reserve released what they called a technical adjustment to their balance sheet operations. 12 words buried in paragraph 7 of an otherwise routine monetary policy statement. Words that Wall Street initially ignored. Words that the financial media didn't even report. But those 12 words just rewrote the rules of the global financial system. Those 12 words triggered the beginning of the end for dollar dominance. And those 12 words are about to make some people unimaginably wealthy while destroying others completely. Here are the 12 words. Reserve requirements will be calculated using alternative collateral valuation methodologies, effective immediately. That sounds boring. That sounds like bureaucratic nonsense. That sounds like the kind of technical language that puts financial journalists to sleep. But what the Federal Reserve actually announced was this. American banks can now use assets other than U.S. Treasury bonds as reserves. They can use gold, they can use oil futures, they can use foreign government bonds, they can use precious metals. For the first time since 1971, the Federal Reserve just admitted that U.S. Treasury bonds are not the only safe asset in the world. For the first time in over 50 years, they just created official alternatives to dollar-denominated reserves. They just gave the global banking system permission to diversify away from American debt. And the markets are responding exactly as you'd expect. But not in the obvious way. The immediate reaction was muted. U.S. Treasury yields barely moved. The dollar index held steady. Gold ticked higher, but nothing dramatic. The financial media called it a non-event. They're missing the point completely. This wasn't about immediate market moves. This was about changing the incentive structure of the entire global financial system. This was about giving every central bank, every sovereign wealth fund, every major institution official permission to reduce their dollar exposure without looking like they're betting against America. The timing is everything. Why now? Why would the Federal Reserve voluntarily weaken demand for U.S. Treasury bonds when the federal government is issuing more debt than at any point in American history? Why would they encourage diversification away from dollars when dollar strength has been America's primary geopolitical weapon? Because they saw the intelligence reports. They saw what's coming in global commodity markets. They saw the coordination between China, Russia, India, and the oil-producing nations. They realized that the BRICS alternative payment system isn't theoretical anymore. It's operational, and it's working. The Federal Reserve looked at the math and realized they had two choices. Choice 1, maintain the old system where Treasury bonds are the only acceptable reserves, and watch foreign central banks dump their dollar holdings in a chaotic, disorderly collapse. Choice 2, create a managed transition where banks can slowly diversify their reserves in an orderly fashion while maintaining some control over the process. But there's a third element they're not talking about publicly. Internal Federal Reserve communications, leaked through Congressional Banking Committee sources, reveal the real trigger for this decision. The Fed's own models show that foreign central bank demand for Treasury bonds will drop by 60% over the next 18 months, regardless of what America does. China has been quietly reducing their Treasury holdings for 8 consecutive months. Not selling dramatically, which would crash bond markets, but simply not rolling over maturing securities. When a $2 trillion holder starts walking away slowly, you either acknowledge the trend or pretend it's not happening until crisis forces your hand. Japan, America's most reliable Treasury bond buyer, is facing their own demographic crisis. An aging population means they need to liquidate overseas assets to fund domestic pension obligations. The Bank of Japan can't keep buying U.S. debt when they need capital at home. European central banks are dealing with energy security issues that require massive infrastructure investments. The ECB needs euros for European projects, not dollars for American bonds. The Ukraine situation accelerated this trend by making energy independence a national security priority. They chose managed decline over chaotic collapse. They chose controlled devaluation over currency crisis. But what they don't seem to understand is that there's no such thing as a controlled transition away from reserve currency status. Once you give the world permission to use alternatives, they will use them, aggressively. The Bank of Japan moved first. Within 18 hours of the Federal Reserve announcement, the Bank of Japan quietly updated their reserve calculation guidelines. Japanese banks can now hold up to 15% of their required reserves in non-dollar assets. They specifically mentioned gold, oil futures, and Chinese government bonds. The European Central Bank followed 12 hours later. New guidance allowing Eurozone banks to hold alternative reserves up to 20% of their regulatory requirements. The ECB specifically highlighted precious metals, energy commodities, and Swiss government bonds. But the real earthquake came from an unexpected source. The Saudi Arabian Monetary Authority, working through the Bank for International Settlements, announced that Gulf Cooperation Council banks could hold up to 30% of their reserves in non-dollar assets, including crude oil, natural gas, gold, silver, and yuan-denominated bonds. Behind closed doors, the Saudis have been conducting emergency meetings with other Gulf state central bankers. The United Arab Emirates, Kuwait, Qatar, Bahrain, all coordinating their reserve diversification strategies. They're not just reducing dollar exposure individually. They're creating a regional bloc that collectively moves away from dollar dependence while maintaining energy market stability. Think about what that means. Saudi Arabia, America's most important Middle Eastern ally, just gave their banking system permission to reduce dollar exposure by nearly 1/3. The petrodollar system, the foundation of American monetary dominance since 1973, just got an official alternative. The wealth transfer is already beginning, but it's not happening where you expect. The big moves aren't in foreign exchange markets yet. They're in commodity markets. Central banks and sovereign wealth funds aren't buying euros or yen to replace their dollars. They're buying physical assets. They're buying gold, silver, oil storage, copper stockpiles, agricultural commodities. The Norwegian government pension fund, the world's largest sovereign wealth fund, just allocated $12 billion to physical commodity storage facilities across 3 continents. They're not speculating on price movements. They're securing actual warehouses, actual storage capacity, actual physical control over resources. The Qatar Investment Authority made an even more dramatic move. They purchased controlling interests in copper mining operations in Chile, lithium extraction facilities in Australia, and rare earth processing plants in Canada. When oil-rich nations start buying other people's mines, they're hedging against more than currency risk. They're hedging against resource wars. Singapore's central bank, working through government-linked investment vehicles, has been acquiring strategic stockpiles of industrial metals, not futures contracts, not mining company stocks. Physical metals sitting in Singapore-controlled warehouses. They're turning their tiny nation into a commodity hub for the post-dollar world. Even more telling is what's happening in agricultural markets. The Saudi Public Investment Fund just signed long-term supply agreements with wheat producers in Ukraine, corn growers in Brazil, and rice exporters across Southeast Asia. They're not buying commodities. They're buying food security for a world where currency stability can no longer be assumed. This explains the strange price action we've been seeing across commodity markets. Gold hitting new highs despite relatively stable currencies. Silver breaking out of multi-year ranges. Oil prices staying elevated despite weak demand data. Copper inventories disappearing from major exchanges. The smart money isn't rotating from dollars to other currencies. They're rotating from all currencies to things. They're betting that the Federal Reserve's permission slip just started the great debasement. Not just dollar debasement, currency debasement across the board. The cryptocurrency markets are experiencing unprecedented institutional flows. Bitcoin, Ethereum, and other digital assets are seeing massive accumulation, not from retail speculators, but from family offices, pension funds, and sovereign entities. They're treating cryptocurrency as digital commodities, alternative stores of value that exist outside traditional currency systems. Major technology companies are quietly restructuring their cash management strategies. Apple, Microsoft, Amazon, companies sitting on hundreds of billions in cash reserves, are diversifying away from treasury bills into foreign bonds, commodity futures, and real assets. When America's largest corporations start hedging against their home currency, the message is clear. Because here's what happens next. As American banks reduce their treasury bond holdings and increase their commodity reserves, demand for U.S. government debt decreases. As foreign central banks follow the Federal Reserve's lead and diversify their reserves, demand decreases further. As Treasury yields rise to attract buyers, the federal government's interest expense explodes. The Federal Reserve will be forced to choose between allowing bond yields to spike, which would bankrupt the federal government, or buying Treasury bonds themselves to keep yields manageable, which would require massive money printing. Either choice destroys the dollar's credibility as a store of value. But the global implications go much deeper. The reserve currency system has allowed the United States to export inflation for decades. When the Federal Reserve prints dollars, those dollars get absorbed by foreign central banks as reserves. The inflation gets exported. American consumers benefit from cheap imports while foreign populations pay the price through currency devaluation. Now that system is reversing. As foreign central banks reduce their dollar reserves and American banks diversify away from treasury bonds, newly printed dollars have nowhere to go except into the American economy. For the first time in 50 years, American money printing will create American inflation that can't be exported. The geopolitical consequences are staggering. Dollar dominance has allowed the United States to finance massive trade deficits, maintain overseas military operations, and impose economic sanctions without facing immediate consequences. Those capabilities disappear when the world doesn't need to hold dollars as reserves. American military power projection depends entirely on financial market dominance. The Pentagon's overseas operations require international cooperation in dollar-based transactions, currency exchange agreements, and favorable credit arrangements with allied nations. As dollar demand weakens, those arrangements become more expensive and politically complicated. Economic sanctions, America's primary tool of international coercion, lose effectiveness when target nations can conduct trade using alternative currencies and payment systems. Iran has already demonstrated this by developing oil trade relationships that bypass dollar-denominated transactions. Russia expanded similar arrangements following 2022 sanctions. Now other nations are studying these models for their own potential use. NATO alliance structures face unprecedented strain as member nations recalculate the costs and benefits of American leadership. European allies are discovering they can maintain defense capabilities while reducing exposure to dollar-denominated defense contracts, American weapon systems, and U.S.-controlled financial infrastructure. Intelligence sharing agreements, traditionally cemented by financial interdependence, are being reconsidered by allied nations who no longer need preferential access to dollar-denominated global markets. When partner nations can achieve economic prosperity through alternative currency arrangements, political cooperation becomes optional rather than essential. Trade relationships are shifting fundamentally. Countries previously dependent on American import capacity are developing regional trade blocs that minimize currency risk and reduce transaction costs. The Association of Southeast Asian Nations is implementing cross-border payment systems that bypass traditional dollar clearing mechanisms entirely. China is watching this transition with strategic patience. They've been preparing for the end of dollar dominance for over a decade. Their central bank digital currency, their bilateral trade agreements, their Belt and Road infrastructure investments, all designed for a world where dollars are optional rather than required. The People's Bank of China has been conducting quiet stress tests of their yuan-based payment systems with major trading partners. Brazil, Argentina, Saudi Arabia, the UAE, all participating in trial programs that eliminate dollar intermediaries from bilateral trade. The volumes are still relatively small, but the infrastructure is operational and expanding rapidly. Chinese state-owned enterprises are receiving internal guidance to minimize dollar exposure in their overseas operations. Construction projects, mineral extraction deals, technology transfers, all being restructured to use yuan, local currencies, or barter arrangements. They're building a parallel financial system while America debates technical reserve requirements. Russia is positioning even more aggressively. They've been converting dollar reserves to gold, energy assets, and strategic materials since 2014. The Federal Reserve's alternative reserve announcement just validated their entire strategy. Moscow is now openly encouraging other nations to follow their example. The Central Bank of Russia has been secretly coordinating with Iran, Venezuela, and North Korea to develop commodity-backed trade settlement systems that completely bypass Western financial infrastructure. Oil for wheat, gold for manufactured goods, energy for technology transfers. They're creating a barter economy for the digital age, and other nations are taking notes. India is playing both sides perfectly. They're maintaining good relationships with the United States while building alternative payment systems with Russia, China, and the oil producers. The Federal Reserve just gave India official permission to hedge their currency exposure without appearing to choose sides in the great power competition. The oil producers are the biggest winners. For 50 years, they've been forced to accept dollars for their energy exports and hold those dollars as reserves. Now they can sell oil for yuan, euros, or gold, and hold those assets as official reserves. The circular dependency that created the petrodollar system just broke. But the most profound impact will be on American living standards. The reserve currency privilege has subsidized American consumption for generations. Cheap imports, low interest rates, deficit spending without consequences. As foreign demand for dollars declines, those subsidies disappear. Americans will discover the true cost of their consumption patterns. The Federal Reserve's own internal projections, shared confidentially with major banks, forecast domestic inflation reaching 8 to 12% within 24 months as dollars can no longer be exported to foreign central banks. Import prices will rise first. Energy, electronics, clothing, anything manufactured abroad will become substantially more expensive. American families currently spend 63% of their income on goods and services that depend on imported components or materials. When the dollar loses its preferential status in global trade, that 63% becomes significantly more expensive. Middle-class living standards, subsidized by reserve currency status for decades, will adjust downward rapidly. The real estate market faces a particularly brutal adjustment. Foreign investment in American property, historically a major source of demand, is already declining as international buyers diversify away from dollar-denominated assets. Chinese buyers, who drove luxury real estate markets in major cities, have reduced their American property purchases by 78% over the past 18 months. Commercial real estate is experiencing an even more severe contraction. Foreign corporations, previously eager to establish American operations to access dollar-denominated markets, are relocating operations to jurisdictions with stronger currency prospects. Office buildings in Manhattan, commercial complexes in Silicon Valley, industrial facilities across the Midwest, all facing reduced demand from international tenants. The stock market represents perhaps the greatest wealth transfer risk. American equity valuations have been supported for decades by foreign capital seeking dollar-denominated returns. As international investors diversify their currency exposure, demand for U.S. stocks will decline structurally, not cyclically. Companies dependent on cheap imported materials will face margin compression. Firms relying on international sales will struggle with currency conversion issues. The Federal Reserve thought they were managing a technical adjustment to banking regulations. Instead, they just accelerated the end of the American economic empire. They thought giving banks alternatives to Treasury bonds would reduce systemic risk. Instead, they created an official exit ramp from the dollar system. What they failed to understand is that reserve currency status is binary. You either have it or you don't. There's no such thing as partial reserve currency status. The moment you give the world official alternatives, you're no longer indispensable. You become optional, and optional reserve currencies don't stay reserve currencies for long. The mathematical certainty is already evident in derivatives markets. Currency swap volumes between non-dollar pairs have increased 47% in the past 90 days. Interest rate futures denominated in euros, yen, and yuan are seeing unprecedented institutional participation. The smart money is hedging against dollar volatility because they know what comes next. The 12 words weren't just a policy change. They were a surrender document, a formal acknowledgement that American debt is no longer the safest asset in the world, that alternatives exist, that the world no longer needs to choose between dollars and chaos. The global wealth shift isn't coming. It's here. Capital's already flowing from dollar-denominated assets to physical commodities, foreign bonds, precious metals, energy infrastructure. The early movers, the ones who understand what just happened, are positioning themselves for the greatest repricing event in modern financial history. The ones who don't understand, who keep their wealth in dollar-denominated assets while the world builds alternatives, are about to discover what it feels like to hold the currency of a former superpower. What it feels like when your purchasing power evaporates not through hyperinflation, but through irrelevance. American pension funds, managing $28 trillion in retirement savings, remain dangerously concentrated in domestic assets. State pension systems, corporate 401k plans, individual retirement accounts, all betting that dollar dominance continues indefinitely. They're about to learn that demographic transitions don't wait for currency transitions to complete. The game isn't ending gradually, it's ending now. 12 words from the Federal Reserve just started the countdown. The wealth transfer from west to east, from paper to physical, from debtors to creditors, is no longer theoretical. It's mathematical, it's inevitable, and it's already begun.